We often blame politicians or corporate greed for our financial instability. But there is a 100-year macroeconomic debt cycle that functions with mathematical regularity, and it historically dictates the future of life savings. Every 75 to 100 years, global debt systems tend to collapse under their own weight. When the debt becomes unmanageable and inequality reaches a breaking point, the entire financial structure resets. In 1923, German children built pyramids out of worthless cash because the currency had lost all value. This same cycle ended the Dutch Empire's dominance in the 1600s, proving that even the strongest fiat systems have a finite lifespan. In those past crashes, the collapse involved physical paper. Today, the crisis is different because physical money is being removed from the system entirely. Central bank digital currencies, or CBDCs, are replacing traditional cash. Unlike the digital numbers in a private bank account, these are issued and tracked directly by the government. This shift gives the state the ability to program how your money is used. At the same time, artificial intelligence and advanced robotics are replacing human labor on a massive scale. As these machines take over the factory floor, stable, full-time employment is becoming harder to find for millions of people. This creates a severe structural problem. With technology eliminating jobs, governments face a difficult choice. They must find a way to fund the jobless masses to prevent widespread civil unrest. To maintain order, governments will likely implement universal basic income. This involves paying every citizen a standard recurring wage to cover their basic needs as traditional work disappears. However, providing a wage for everyone requires an enormous amount of capital. To fund it, authorities must look toward existing pools of wealth that are already recorded within the system. If your wealth is held in standard stocks, large commercial bank deposits, or legacy pensions, it exists inside a controlled environment. Because these assets are tracked by the state, they are easily accessible for redistribution. Instead of a sudden seizure, you may see large retirement accounts quietly devalued, or pensions partially written down. The digital system allows the state to redirect this value to fund the broader basic income pool. Authorities will likely frame this wealth transfer as a necessary step for economic fairness. They will describe the reduction of private savings as a contribution toward a sustainable social safety net. For those with no capital, like the men in this Depression-era breadline, the reset looks like a rescue. But for those who spent a lifetime saving, it functions as a targeted extraction of their accumulated labor. Historically, the wealthiest family dynasties avoid these losses by moving their capital into assets that don't sit on a commercial bank's balance sheet. They execute this strategy long before the system reset begins. As long as your savings remain in traditional financial vehicles, they are vulnerable to the rules of the new automated economy. The state can rewrite the terms of those assets whenever the system requires more funding. The strategy used to survive these resets involves moving capital into hard assets that exist outside the traditional banking infrastructure. Physical gold is a primary target for this strategy because it cannot be printed. As this rock quarry shows, extracting new gold is an expensive and difficult process. Its rarity makes it a resilient store of value when fiat currencies fail. It is important to distinguish between physical metal and paper gold. Paper gold consists of digital contracts that may not be tied to a real supply. These contracts carry the same inflation risks as the currency they are meant to replace. Bitcoin serves as a digital alternative to gold. It can be held personally and transferred easily, operating outside the direct reach of commercial banks and state sanctions. However, Bitcoin is a relatively new asset. It has only been widely used for a decade, meaning we don't have historical data to show how it responds to a century-defining depression or global conflict. It also faces ongoing regulatory risks from governments. Real estate offers a different kind of protection. While it is easy to tax and remains inside the government's legal framework, it has intrinsic value because people will always need shelter. During financial collapses, urban areas often see a rise in crime and volatility. Because of this, remote or self-sustaining land is often considered the most secure real estate option, as it provides a physical buffer from the instability seen in cities. No single asset is perfect. But shifting wealth into physical, decentralized, or intrinsic vehicles is the strategy used by those who want to keep their capital from being absorbed by the digital UBI system. The combination of rising debt, automation, and the shift to digital currencies creates the specific conditions for a global financial reset. While the broader macroeconomic cycle is beyond your control, your personal vulnerability to wealth confiscation depends on the choices you make before the transition is finalized. If your wealth remains trapped in legacy systems, the state will dictate how it is used. Reallocating your portfolio is the most direct way to maintain your financial agency in the coming years.